Welcome Thursday to our real estate credit. I'm Jeff Rodriguez, co-founder of Boost Capital Group, where we work with busy professionals to provide opportunities to invest in real estate opportunities in the commercial side of things, specifically focusing on multifamily apartment complexes. We put this real estate credit together to essentially just go over the nuts and bolts of real estate investing as both the passive or active investor. We're always open to suggestions for education. This is more of an educational platform. No need to worry about talking if you don't want to. It's just more educational purposes. Always welcome. Philippe's going to go over a few things, and we're going to go ahead and kick this off.
Yeah, thank you, Jeff. So today the topic is back to basics. We're going to talk about kind of an introduction to multifamily investing, as usual, as Chris mentioned, as Jeff mentioned, sorry. Our focus is on in-place commercial multifamily value add strategies and syndication. So let's go to the next slide. We added a disclaimer. We do not provide tax or legal advice. The material here is for informational purposes and should not be construed as investment advice or an offer or solicitation to buy or sell securities. Two-bit slide about it. Jeff and I, we founded Boost Capital Group. As also Jeff mentioned, we provide investment opportunities in alternative investments in commercial multifamily real estate principally. And our philosophy is that we believe that busy professionals should not have to compromise or choose between spending time with their family and securing their financial future. Our key values: passion, integrity, accountability, teamwork, and professionalism. So far, we're about actually now 3,000 plus units, portfolio probably in the 400. And on full turns to date, we've averaged a 30% annual average return, 20% average IRR, 2.5 equity multiple. That is on a 5-year annualized time frame. So today I have quite a bit of slides, and again, we wanted to talk about kind of introduction to multifamily. And we're going to go over 5 topics: understanding the different asset classes available to invest, the reasons for investing in real estate in general, then more specifically multifamily, and then what the advantages of passive multifamily investments, and what is a multifamily syndication. Again, for the sake of time, I'll go relatively quickly because I have 30 slides and I want to spend time on the added value pieces. But for asset classes, just for context, you have cash-based type of investments, equities such as stocks, fixed income, bonds, and then a lot of alternative investments ranging from real estate, precious metals, cryptocurrency, and even loans in that last box. What's interesting, I think, is a chart we put together. We started a few years ago, and it's to compare the different asset classes. And the chart is showing the different asset classes that were on the previous slide. And vertically, you'll see the average return over the past 10 years. And horizontally, you see the volatility, which is basically volatility is like how consistent returns are in general. So for instance, if you take the brokerage dot, which is basically the S&P 500 index, so of the 500 most popular stocks, or most important stocks, let's say, in the US stock market, there are high returns, about 13%, but also high volatility, meaning that Maybe 1 year you'll do 20% up, and then the next year you can do 10% down. Just as an illustration. So what you should aim for is lower volatility. So that would be the left side of the chart, and higher returns. So as of 2022, with the data that we compiled, the multifamily investments was the only asset class that was filling that ideal box of low volatility, meaning low ups and downs, and higher returns. I hope it's clear. And as you can see, we plotted the inflation, and you can see that, again, it's on average for the past 10 years, savings was very low. Obviously, I know more recently it's a little higher because of the interest rates in general. If you look at savings, CDs, treasuries, the returns are below the inflation level. So you're losing money investing on those. REITs, slightly above, but high volatility. Single family and multifamily, very close one to another. Don't hesitate if you have any question, by the way. A couple of questions when you look at these returns, this chart, and your personal experience. Has the stock market volatility negatively impacted your investment portfolio? That's one question you can ask yourself. And the other one is how you're hedging against inflation, which actually in a separate presentation, you can see that the value of real estate is tracking very closely to the inflation level. So that's, again, it's a good way to invest money, the real estate asset class in general. So now we're going to dig a little bit deeper and talk about the real estate investment class as a whole, and see the 5 top reasons why you should invest in real estate. Number one is cash flow, and cash flow being you have the income coming from the rents, you have your expenses, you're paying your loan down. That's going to be cash flow that you can pocket on a monthly basis, traditionally on a real estate property. So the one way is you're going to get some return on your investment on a regular basis. The other way, the other benefit is that your equity is going to build up, because most likely you're going to buy the property with a loan. And again, with the income coming from the rent, it will help you pay down the debt. And from that standpoint, your principal is going to be paid off a little bit at a time. And your equity, your money into that particular property is going to grow over time. Next, we have the depreciation, and that's going to be something we'll talk again in the coming slides. And that's a tax write-off. On single family, you can divide the value of the building by 27 and a half, and each year you'll be able to reduce your tax bill thanks to depreciation. Talk to your CPA. Oops, sorry. And finally, it's not the final, but the next point is the leverage. So you can buy properties using debt from lenders, from banks. And for instance, you can invest, let's say, to make round numbers, if it's $100,000 property, and I bought a few of those many years ago, you can buy those properties with 20% down, with $20,000. And then you have to do the math and see. Now you can buy with $100,000, you can buy 5 properties, really.
Yeah, and just to touch on something, keep in mind that in comparison to a regular stock portfolio, which most folks on here probably have that as part of their investment portfolio, some folks don't invest in real estate. They just have the stock portfolio, their 401k or something like that. Everything that they invest in is money that they essentially earned. Obviously, the benefit here you see is that partial 20% that you've earned, you can invest, in turn adding leverage to your portfolio by borrowing from the bank. So that's I think is a huge plus when it comes to investing in real estate because you can't really borrow money. You can, but probably not the best thing to borrow money to buy a portfolio of stocks.
So the last reason to invest in real estate is appreciation, and it goes back to the hedging against inflation I was referring to earlier. So you can see on this chart is the Case-Shiller index tracking home prices. And you can see in general, so obviously during the 2008 crisis, it went down, and it went down a little bit recently as well. But overall, there is appreciation in real estate prices. So good hedge against inflation. Now, I think so. So this first chapter, let's say, was pretty much focused on the real estate market as a whole and maybe touching a little more about single family. And now the concern, I would say, with single family is like how you scale from buying house by house. And then it becomes like a workload concern. So that's why it's interesting to take a look at the benefits of investing in multifamily. So we're going to go over 5 topics. First is the economy of scale, right? And I think a simple example is the cost of managing properties. When you manage a single family, you're going to pay between 8 and 10% to get the properties managed by a professional manager. When you go to multifamily, depending on how the property manager is organized, it can be as low as 3%, actually. So that's one example. But you can think also about just buying materials when you're going to renovate many units and etc. So the economy of scale, it adds up very quickly in multifamily. Next, the tax benefit. So what's interesting with multifamily is that you can accelerate the depreciation by doing a cost segregation on the buildings. And so it's called the cost segregation analysis. So meaning that instead of the 27 and a half years, an engineering firm will analyze and categorize the different materials and take into account their useful life and depreciate on a shorter time scale some of the materials. In addition to that, there is also bonus depreciation that is in effect for a few years. And I understand that the 100% bonus depreciation was voted for this year. So that's good news because I think in theory we're at 60%. So there's an additional depreciation factor there thanks to the tax laws. So again, now understand one thing, the bonus or let's say depreciation, it can be only written off against passive income. It's not something you can write off. And I'm talking for the vast majority of people who are, and especially if you're not real estate professional, you really have, I know it's very interesting sometimes for investors to consider that, but you have to have a discussion with your CPA to see if it's really a benefit that you can take advantage of this depreciation. But again, there's more depreciation in multifamily. The forced appreciation. So we spoke about appreciation before for more like the single family. And the chart I was showing, it was more pertaining to how the market appreciate in general, how the prices are rising. But also, if you consider, if you're going to renovate a house, add a bedroom or things of that nature, you can force the appreciation of that particular house. So you're going to bring its value higher by adding a bedroom, for instance. And I think the difference between multifamily and single family, the single family is going to be very much value, will be very much a factor of its market. And how many square feet, how many bedrooms, again, how many, what's the land size, etc., the schools and whatnot. And so in single family, the value of the house, at the end of the day, it's a very much a factor of the very local market, right? Now, if you look at multifamily, for instance, and commercial real estate in general, here the key is going to be the cap rate. And really, the cap rate is a function of the net operating income. So how much income you're going to the particular property is doing, divided by the value of the property. Or in other words, value of the property is net operating income divided by cap rate. So cap rate, similarly to single family, it's going to be a factor of the particular market. But if you look, let's say you have a 5% cap rate in a particular market, right? If you're able to increase the income of the property, automatically its value is going to rise. And if you consider two properties that are in the same market, same cap rate, if one of them has a better net operating income, automatically its value will be much higher. All of this long explanation to talk about forced appreciation, because you can increase the income, decrease expenses in order to achieve a higher net operating income. And that's exactly our typical strategy when we do the value add strategy in multifamily. We're going to look for properties that have rent that are lower than the rest of the market. And we're going to reposition the property through renovations. And after, we may charge for utilities if it wasn't done, add additional fees and services as well, for instance. That's all to increase the income. To decrease expenses, sometimes the property is not operated properly, and it's like a kind of a mom and pop type of ownership. And we're going to bring professional property management and streamline, have more efficient management and lower the cost from that standpoint. There are also some other examples: water consumption reduction plan and other tax incentives that you can work out with state, county, or cities, it happens in some market. Again, in the long and short of it, increase your NOI. That's how you can force the appreciation, increase the value of the property. Risk reduction, I think what's interesting here is to think about multifamily. You have multiple units, meaning that if your vacancy is going to be in line with the market automatically, or rather, you can very easily bring the property in line with market occupancy, and let's say it's 90%. And in that case, compared to, let's say you have a little portfolio of 5 properties, if one of them is vacant, that's automatically 80% occupancy, right? So now if you have 100 units, it's going to be much, much easier to spread out the risk and maintain your occupancy and manage rents and etc. Finally, the workload. Again, for each property, you're going to look for them, underwrite, negotiate, secure the capital, do the closing, the managing, etc. When you're looking at a portfolio of individual properties, it's going to scale up very quickly, and you're going to have to spend much more time compared to buying 100 unit property and have to do this set of tasks only once. Now, one question you may ask, and again, that's what we do kind of day in, day out with finding deals, funding, managing, and so on. But it's like, how much time do you have to spend on those things? And the other aspect is, do you have the right knowledge to take care of it? We have an answer for you, which is passive multifamily investment, which again, that's what we do. Change my slide here. So the advantages now, you go from being more active to passive. So you're going to work with a sponsor or a general partner who has a deal and basically build a relationship with that sponsor of the deal and basically send them your funds to in order to achieve the returns on the property. So you're working through someone to take care of the investment who has this and is doing the groundwork on the different pieces there or the different steps to underwrite and find the ideal investment. You have also access to large investment and you'll be able to diversify through the syndication model. And we'll talk a little more about this in a minute. But the concept is you're going to aggregate capital through a syndication to buy a large property. And that's something that individually it's extremely hard to do unless you have very deep pockets. And typically the investment structure allows to participate to large multifamily projects for as low as $50,000. And from that standpoint, you don't have to tie all your money in a single investment. As I mentioned, you're going to benefit of the experience of the sponsor, their track record, their knowledge, and also their network of third-party experts, which takes a long time to build. And the final point here is the protection. Each syndication is going to be held through a limited liability company. So sometimes people are asking me, should I create an LLC to invest in a particular deal? And I think, again, that's something you have to discuss with your own CPA, attorney, and so on. But from the particular investment and exposure and risks pertaining to that investment, your exposure is limited thanks to an LLC, limited liability company. All right. So how a syndication works? I guess I see some questions. We'll get to the questions. Yeah, please just put your questions in the chat if you don't mind for now. I'm almost done actually. I went much faster. I know I went fast, but just another couple of slides. Here, just we wanted to describe the syndication structure. And I know sometimes when I started back in 2016, I had not heard about what the syndication was, and it was very interesting to learn about it at the time. But so the idea of a syndication, I think there's multiple sides to it. The one side is how the C I mentioned earlier is structured. So the property is going to be the owner of the property is going to be a limited liability company, an LLC. And yeah, as I mentioned here, it owns the property, it provides legal protection, and it's going to be governed by an operating agreement. It's a document describing how things are going to operate. And basically, what the operating agreement says is that on one hand, there will be general partners or the managers of the LLC. I'm showing on the left here. They are the ones actively operating the asset and executing the business plan. They provide the business expertise. They will contribute some of the capital. And they will, in exchange of their participation in the deal, they will receive some equity and also some fees. And on the other side, we have the limited partners. So those are the passive investors. They will contribute capital, they will receive equity in exchange, they will receive distributions and the tax benefits. So that's from the kind of corporate kind of diagram, if you will. And the other side is more what I want to touch upon here is the SEC regulation. So the Securities and Exchange Commission has written the Rule 506C of Regulation D that describes how these investments can be put together. So basically, as sponsors or general partners, we're going to talk to an SEC lawyer, and they're going to form the company and write the paperwork in a way that meets the SEC requirements. And basically, there are two general options. There are more options available, but the two very common ones, 506B, 506 regulations, both of them have their unique features. B means you can have, let's say, sophisticated investors as well as accredited, and C is only accredited investors. And the accreditation is based on income or net worth. Or there are also, you can have a license to basically, if you are like a financial
Question.
advisor or something like that. But the two most common is either income, 200,000, if you're single, 300,000, if you're married, and net worth is $1 million for now. May change in the future. So the SEC lawyer will put together the private placement memorandum that is describing the investment parameters and risks, and as well as the business plan that will be provided to investors. And the investors, they have to review the private placement memorandum, sign a subscription agreement, and also sign the operating agreement of the LLC. So those are the legal steps there. And I think Jeff already put the link, I believe.
Yes, I dropped a couple links in there, and I'm sure a lot of folks are somewhat familiar, if not intimately familiar, just about the depreciation, the cap rates, and the definition of the SEC's accredited investor. There is a question from Beatrice. What is the minimum investment requirement, and how long will investors pretty much, when will they start seeing returns?
So yeah, in minimum investments, it depends. I think like a very generic number is going to be $50,000, but it could be less. That's really kind of case by case. I know depending, when we have new investors coming with us, sometimes we go a little bit lower, but and some other operators, they have 100,000 minimum.
So there are several variables depending on the class also of investment based on returns. There's different class of investments in a single syndication. So someone can invest 500,000, get a pref along with a higher waterfall of returns versus someone that invests 50,000. They may get a lower pref or lower return. So there's a lot of variables involved. Some funds are just straightforward 50,000, but it all depends, and all that's going to be in the PPM or in the investment documents. So there's not a one size fits all, one standard in regards to how much a minimum investment is. But for a lot of the multifamily commercial side of things, you can expect to see anything from 25 all the way to 100,000 for a single investment and higher. But when you do through a fund, you get to diversify. So there's a lot of different things that we can go down and talk about more. But just to answer your quick question, hope that kind of, oh, and then how long till investors start seeing returns? It could be about every quarter, depends on the investment. You could see monthly or quarterly. Usually the PPM or the fund or the investment documentation would state when you should expect to start seeing returns, and also comes with consistent communication with the investors. So like I said, it is not one size fits all.
Yeah, and almost most recent deals actually are like, or three most recent deals that we added to our we offered to our investors, they actually started to do distributions pretty quickly, which was like 2 months, 1 or 2 months after closing. Usually it's longer. Usually it's 6 months. Sometimes it's even a year. We've upped our selection process and working with trusted partners as we gain experience. And so far, for like the last few investments, as I mentioned, we've selected. I think it's pretty remarkable. Yeah, you have to look, and that's where I think Jeff and I we bring value. Is really we leverage our own experience doing that for many years to pick solid partners, solid markets, and like we want to have the best odds of high returns.
So with that being said, feel free to reach out if you have any questions or suggestions on topics of interest. We'd be happy to put something together and provide value in the form of education. So that's why we started this every Thursday at 7 p.m. Eastern Standard Time. Real Estate Accredited, just here to educate where we can or answer any questions.
Last call for questions. Notice, I see Chris posted the link for the bonus depreciation. Thank you.
Yes, thank you so much. With that being said, thank you everybody for joining us, taking some time out of your day. We really appreciate it, and we hope to see you next time and add value.
Thank you, everybody. Have a great evening.